Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for July 7th, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. We have a lot to cover here in this 45 minutes. I did a video yesterday, quick Strategy of the Day update, just kind of doing a precursor to today's video, but we will try to get through everything as quickly as possible. Remember, I can always be reached over here at Zaner at 312-277-0110. You can find me on Twitter, on Facebook, and shoot me an email at dhussey@zaner.com if you want to have more discussion and take this into a more personalized discussion just for you. Okay, so let's begin today. Actually, I guess let's just start with our row crops because I think everybody's kind of asking or curious today if this could be a potential bottom. I'm going to begin with corn because that's the place where in the market where I think that we have the biggest justification for that type of bottom potentially occurring. One of the big reasons that I see, at least from a larger time frame here, a very substantial low potentially forming is this full 50% retracement. Each platform is different here how you draw these. I was pulling the wrong direction there. But from contract low to highs here for December corn, we've traded down into that 570, 50% short. We went below the 200-day moving average, so we've had a solid test of all our downside technical indicators. And we did test down here to down into this old inflection zone. The highs back from May through October, the breakout level that we then saw through and into 2022 here, those old highs have now been tested as broken resistance, now as support. We went from oversold in the stochastic here over the last week or so and are starting to come out of that, placing 0.20 here and going back towards neutral. Is also a short-term suggestion that the momentum to the downside could be over and we might be seeing a relief rally. Now, there's going to be plenty of resistance to the upside, certainly some levels that we'll talk about. 200-day moving average being below that. Now, that could be resistance. The 18-day moving average, as it gets drawn down, we will look for that. If we do set up in a, basically a top is in place and we're heading down lower in a move lower, we would expect to see that 18-day moving average potentially become some kind of resistance to the downside. 100-day moving average at 686 and 55-day at 710. It's kind of amazing that we're so far away from those still, almost $1 from both, which is why I think a recovery rally to back to reversion to the mean a little bit here might be necessary. Now, does that mean we go to new contract highs? No, but we are certainly setting up with today's kind of key reversal, having put in that positive day, kind of a doji yesterday, higher high and higher low today, and filling that gap on December corn. Were all good starts coming off the lows. So on the 1 hour or the 4 hour chart, let's bring that up here. Yesterday we talked about our three open gaps: 730.5, 673 and 3/4, let's just call it, and 606.5 here. And yesterday's price action actually Tuesday's price action got filled today. So we can remove that gap from the chart. I mentioned we had also come all the way down, and this is where I got to go out to a daily chart real quick here, and filled a gap here way back from February 4th through the 7th. That was at 574. The 567 full 50% long contract low to high that traded filled that gap as well. So we've cleaned up the chart with all the downside potential that I saw, and we were kind of watching maybe some levels that we could go down into. The next in the series short here, we could draw it, kind of one of two ways here, which might have traded, which is a reason I'm a little concerned that where we rolled over from here today for corn and beans might bring up a new low or at least a test of lows. But certainly filling the gap is the first signal to me that the market will potentially want to head higher. The most aggressive, and I'll put these back up in a second, the most aggressive 50% short that we were talking about here coming out of yesterday's price action was from basically the gap level to lows. That 50% area at 584 to 589, we broke through it. So there is the chance now for an ambush long. This is drawn from the low to high now on this hourly 15-minute chart, whatever. It's yesterday's low to today's high. Look for that 50% area around the 587 to 582 to hold the support. And if it does, we'll be probably going up to 620, and then really at that point targeting new highs for the month of July, which to me constitutes a reversal. We would at that point be breaking above every extended short or lows to lows. The aggressive selling that we went into became one of these lows to lows levels, and that would reverse the trend in my opinion. The down, if we draw, it's really silly almost to draw trend lines against the highs here because they're so steep, but if you do draw a trend line from our 2 Fridays ago high all the way up in the highs of June through the highs we had there post quarterly grain stocks and the turnover that we've had, we can see that we kind of ran into that trend line here today as well. So I'm a little concerned that today's high might be a bit of a bear trap, but everything, my gut tells me no. I certainly spent the day looking over options, and some of those options I'm going to talk about right here, right now, because I think that there's some value to be said for in these markets right now, given how far down we've come. So I was looking at December corn here today. A strike I had picked out and was kind of interested in here now was the 620 call. We were getting that done for it looks like 43 and 3/4 cents here at some point. Okay, that's a lot for an option that's only 20 cents out of the money. But again, we're only 20 cents out of the money with that 620 call. Selling 720 calls against it brings in 20 cents roughly. So here it's going for 27 cents. That's not how much I was doing it for. We were getting this done for around 24 cents. So keep in mind these numbers while the market's closed is, I'm sorry, it's 43 cents. There we go. That makes sense. 43 cents for that 620 call to buy that, and then again 20. Where is it? The 720 call here. Now you can see it going for 20 cents, 23 cents, 24 cents, going for that dollar wide spread. We don't have to get that far, right? The market doesn't have to recover that much for that to go into the money. In fact, if we go through, excuse me. Wow. Newborn, it's 3 months old, tend to keep you up at night. But anyway, that dollar wide spread, we only need to get back, if we go and back to our technical chart here, we only need to go through highs of July to start seeing that money, that spread go into the money. And then if we go back up towards that 730 gap fill, you're making max gains on it, or theoretical max gains. And if we do go up there quickly, you're going to probably, seek to at least double your money on this type of spread. It won't be, unfortunately, if we go up there fast, won't be worth what the full value, that full dollar. But okay, if it's worth 50 to 60 cents, that's a great, still a good gain. And again, we have all the way through December on this idea. You might consider doing short-dated options on that new crop. If we think that the next 2 to 3 weeks are all we need for the market to really get going and to head higher, well, basically 2 weeks, right? We'll be into pollination. If we think that weather market's going to come back over the next 2 weeks, this September on December option spread makes some sense to me. And there I would still be looking at the 620 to 720 spread. But notice that it's also going for about 20 cents. So you're not saving that much money. But if we're only spending 23 cents, well, and we're pretty confident in the market going up there, for 28 cents, for 5 cents more, we could just own the 620 call outright. Now, another idea here might be for you, if we're talking about something in the 20 to 25 cent range of cost, well, just going along futures here, right at the money at where we closed, 20 cents of risk gets you to just above the lows. However, I would take that a step further and actually come in here and probably buy. Let's see here if we can get that cost down. We might only use August in this case because it's August on December still. So we're using a put. The August on December puts, which I have up now, They only have 15 days left on them, but we can trade a December future. Let's say you went long at 596. Let's just call it five. Let's just call it $6, just because it's 4 cents higher than where we are right now. If you're long a future from $6 right now, we can get a stop in there at 580, or 585 or 590 for 19, 16, and 13 cents. So that sweet spot here at a 16 cent cost plus the 15 cents of risk from where you'd be long. Really, it's only 10 cents of risk because we're trading at 596. But for 30 cents out of the pocket in terms of a stop, you can have that stop at 585. And if we're going higher, you only seek to lose this 16 cents now, rather than the 25 or the 30. In other words, I'm looking to utilize a put option to create a synthetic call at these levels. And of course, there's always the idea of simply buying this pullback towards 587 to 585, putting a stop either below the low or somewhere around 580 below the 6218 line. And if we do then break above trend line here, go to 620 and new highs for the month, we're off to the races. We're trailing stops. We're making higher highs and higher lows. And we're heading up probably to that 673 gap fill above us. And of course, the 730 level. Full 50% off the highs, just to give us an idea of some levels that, for producers, I would consider start selling at. Because again, if we're going to be going long December futures, December 620, 720 call spread, let's say, on the way up, if we haven't done any sales, that gives us the courage to then do sales, right? We don't need to worry about being short a crop if this turns into 2012, because we'll at least have, until 720 we wouldn't, because we'd have a call spread on that would make up for the next dollar higher. Once we go above 720, however, you would probably want to reopen the upside. But that's a conversation to have at another day in a dollar higher. And there's ways that we can talk about doing that when we get up there, right? But back to the 666, back to the $7 level, getting back up to the range we broke down out of. Because remember, before all this, we were, kind of looking at corn as a big range here for the last 2 months between 690 and 770. That's 70-cent range. If we get back up into that area, I think everybody should peel something off. We don't need to. We don't need the market to go much higher than that, right? To have a decent sale, on the year. And in fact, selling, $6 corn for cash sales, right, for a producer, still not bad levels, but we've come down so far so fast that the reversal seems to be underway. We're coming off of these very, the larger time frame, full 50%. Let's go out to the daily chart there. That full 50% retracement for the entire contract, right? The old highs that we broke out of there going into this year, we erased 2022's gains, came down to old trendline support, filled that little gap on the chart we have right here at 670 area, or the 570 area back from February, and we've started to get a reaction higher. Follow through today's highs, I think lead the way to a new high for July, and we have open gaps at 673 and 730 to fill. It's a big reason why I advocated and was talking about today with clients the 620, 720 call spread, because we don't have to go back to new contract highs, has limited risk, and is designed to profit in the recovery in this range. All right, so let's move on. That was a lot of 15 minutes there just on corn, but I think it was important to cover corn to that, to that extent, because it's got, I think, one of the best opportunities for recovery over the next 2 to 3 weeks into tassel. All right, so let's move into our soybeans. Very similar to corn, I think a reversal is somewhat underway. It's just tough to find the big technical level, I would say, for soybeans to be coming back up from. There is a level, though, that, the old swing here from basically last June's low, so the last year of price action effectively to new highs. Try drawing that fib again. And we'll look at this on the other chart anyway. Perfect. We came down into that 50 to 6218 line from last June to this June's high. So the last year price action did 2 steps forward, 1 step back. There's a very, very nasty step back at that. It's kind of equal legs too. That if you measure here the distance from our 1580s highs, why do not my drawings not want to work today? There we go, down to this 1400 low. Extend that from that bounce we had up towards 1505 there on the our last on our quarterly grain stocks. And oh, sorry, let me get the other chart up here for us. There we go. So this distance down, this first drop down, in both time and in price, mind you, right? It was a $1.80 drop here from June 8th through the 1400 low there on June 22nd. We then rallied and had some short covering into quarterly grain stocks. We tested the 200-day and 55-day and 18-day moving average as resistance, and then we rolled over hard. And in almost the exact same amount of time, I mean, less a day or two, but definitely the same extremity of $1.20 lower here, basically $2 lower. We fell down in equal legs. So that's 3 waves down in equal legs to test below the 200-day moving average, which we have rallied back up to hold as resistance here today. But notice the daily stochastic here on corn has reversed out of that oversold territory. So again, signaling here that if we can recover back above this 200-day moving average, get up there to fill that gap at $14, we're very likely in some kind of recovery. Is it enough to take November back to contract highs? Maybe. I mean, if we have a repeat of 2012, excuse me, I think we will. And something I think we'll probably, I might do a video tomorrow specifically on this, but going back and looking at 2012 price action, actually, if we have a time today, maybe we just go ahead and do that now. I'll have to bring up the continuous contract here for soybeans, and I will go back, but I think it's important to go back to that year to see some of the price action we had to understand how much this market can move and recover in just a short period of time. And of course, every year being a little different, let's flip on over to that now. So I haven't really prepared this or tried to seek out what I was wanting, but okay, so going back to 08, 09, I mean, we had massive swings here. This is actually not a bad example of it here. Through March, April, May, June topped out. There we go. June topped out, July, August, October, down through November, and we've based and started heading higher again. Here's our 2012 price action. We had, $2 sell-offs in April and May. That was our early top that we actually bottomed in June. I mean, a little different time in the chart, but I mean, this is effectively the same sell-off we just saw. The month of May here is effectively the month of June, July. So for everybody to be reacting like they are to this sell-off that it's unprecedented, we've never seen this type of stuff before, it's not exactly true. Yeah, it happened really fast, but over the course of maybe just 2 to 3 weeks, this took an entire month. But this was the sell-off from 15.12 down to 13.20, not so much different. And after that sell-off, we've rallied, keep in mind, from $13.50 up to $18. And it only took from June through September. Well, if this is starting in July, okay, it's going to take till October. And maybe do it faster because everything's just moving faster. So my point is that we've seen these types of moves before. It's just, it's wild. It's wild when we have to go through them. So here's another move that happened, and actually, it's kind of basically, what is this, August through, October, what have you, extending into December. But yeah, nasty sell-off from $15 all the way down to 11 and 10. I mean, that was a There's a $5 swing right here over these couple months. We still bottomed out at $11 and headed up to through the next crop year and into the next seasonal high up to 18. So could we have a little bit further to go? Absolutely. We need to be very mindful of that. Beans are absolutely unforgiving when it comes down to it. But if we take this, I guess, daily chart from 808 lows to the highs, and this isn't, yeah, it is a daily, it's the continuous chart. That swing is the 50% pullback we saw, which was something I wanted to point out here. Now going to the straight November chart, because again, continuous charts are great, but we really need to be concerned with what our actual chart's doing. Same acre new high from this high way back in to start the year effectively. Highs to highs, or I mean, I guess what we could call just right the start of year price action, up to new highs is the 50% that we were finding here at 1329. So it's basically just a pullback for 2022. And actually, this is going back to 2021 for November beans, right? So it's 2 years worth of price action, 2 steps forward, 1 step back, 2 steps forward, 1 step back. The market, or you could call it 2 steps forward, 1 step back. The market is effectively down into trendline support. Was below those levels, but has come back above them here and is now back to testing that 200-day moving average. We will, I think, have some congestion up around this 1400 level. It was the range that we had been in for the last several months. It might take a little chewing to get through, but I do think the market's probably going back up there to test 1400, not only because we have an open gap at 1395, but because 1500 is also the next in the series. And let's go down to the 4-hour chart now. It's also the next in the series, 50% short. So into our quarterly grain stocks and acreage estimates there from last week, we had a 50% short off the highs from the 1584 high down to the 1400 low. We spiked in that news report up into that 1492 area and headed down to its 1356 targets, even went through those targets. Yesterday's report, strategy today, we were talking about the potential for the lows to lows extended shorts that were on this chart. Well, guess what? Those have all broken their 6, 2, and 8 lines. Now all that we're left with, going down to a 15-minute chart now, is the next in the series from that old entry high on quarterly grain stocks down to new lows. The 50% short around 1405 we need to be aware of. Okay, and then there's, this is one that I actually put up here today because I was, justifiably trying to find a level that we could be holding. This would be the first time this extension is really traded, and it's the old low there because we were in a series of shorts off the highs here. 1, 2, and 3 that was just stair-stepping. 2 steps forward, 1 step back. 2 steps forward, 1 step back. 2 steps forward, 1 step back. And then the market broke down. I have it highlighted now, blue. That old 50% went to and through its target. So from its low, from the pull to new lows, okay, maybe this is a resistance up here at 1365, and maybe a little bit of cause for concern again for the market having rallied back up into these levels. But I do think that if we push above 1380, go to fill the gap, we're going to 1400, and I mean, I believe we really will have broken this entire series lower, or a true confirmation of the reversal. Unfortunately, doesn't really occur for me until 1440. But by that point, we're already $1.30 off the lows. So that's a pretty wild move, if you ask me, if it's got to get up there. So I am using these more aggressive levels that we had already broken, which included, if we really, I'm going to take this one off the chart real quick and just kind of concentrate on, since the gap lower, what we did. Well, we had a gap lower, and the market clearly set up in a full 50 back here on that in that first day, back up into 1355, sold off down to new lows. Next in the series was drawn from that high down to the new low. That was giving us a reaction here at 1330, but then eventually, failed out, still went down to a new low, but nevertheless, we then rallied back above those levels. Now, earlier today, in early trade last night, there was actually a little ambush long here off the low that began a trend higher. So you have 2 steps forward, 1 step back, next in the series from low to high. As that entry at 1323 went to its 1352 target. Next in the series here, traded back to 1340, went to its targets. Next in the series from entry high to from entry lows to target highs, Traded the next in the series, pull back here into 13.55 in the afternoon. At any point now, if one of these fails, expect, and look for that ambush long support from 1302 to highs. So, okay, maybe a pullback to 1340. But today I was advocating, just because we've come so far so fast, it looks like 3 waves down in Elliott wave. We've started to reverse that daily stochastic. We've got open gaps above us, 2 of them, mind you, one at 1359 and the other up at 1536. I do think this market has some cleaning up to do to the upside and a reversal probably underway. So today I was looking at 1420, 1520 dollar wide call spreads in the November beans. Again, very similar to corn. It's pretty close to the money. I mean, 50, 60 cents away for the beans is a lot, like a 20 cent being 20 cents away, I suppose, for corn. But we don't even need to get up to this gap fill or all the way back up to contract highs to hit maximum potential gains on that call spread. The other idea I was looking at was a January 1520, 1720 dollar wide call spread. Both we're going for around 25 cents today. That January one gets you another 60 days and opens up that upside to 1720. So depending on, of course it's from 1520, so we got to go back up to the levels we were at our quarterly grain stocks basically. But I think we're still going to get to 1500 to 1520. Really up to that 1536 gap fill if this reversal continues here, which I do think we have another few days of short covering and higher price action for soybeans, but we'll see what happens. We know there's resistance at 1405s, and we know we're trading a small series of longs off the lows. So at the very least, the knife is no longer, getting long this market is no longer catching a falling knife. There's the potential to be a buyer and a pullback towards 1340 with stops below 1325. But again, I think the most risk-adverse strategy here is to utilize a call spread. Because if we do go lower, you can always buy back the short call, roll down the long call, and manage the position in that way. Real quickly, wheat, and then I want to move on to some of our other markets because there's a lot to talk about in cattle, bonds, crude, all here today. Wheat has completely erased that what's it called? That Ukrainian wartime bid we saw in the market, looking very much like a top for wheat. But, like our other row crops, we've come down to test below all 3 of our major moving averages, and the 18 days now being dragged lower. I do think at the very least for wheat, and I'm not willing to say that we're going to go back up to highs here without some other inflationary effects, without causes to concern, and mainly because it's looking like Canadian acres and Australian acres will be making up for the additional almost 10% extra in both those places will be making up for the loss of acres in the Ukraine. And even though I don't really believe, Russia is going to be able to get, or the Ukraine are going to be able to get acreage, onto the global market, and there's just so many headwinds there. There's clearly some other reason why we're selling off, right? Because thinking that all that production out of Russia is going to make it, or out of Ukraine is going to make it, is just kind of crazy. So the answer to that is that we're seeing other places like Canada and Australia having, decent production that are probably going to make up for it. We're out of the oversold territory here with this key reversal. We did doji yesterday. We now put in a higher high after that. So a move back towards $9 for wheat is probably in the works. I would expect it to come back to its 18-day moving average, which will drop down a little bit. But definitely let's get back to test that 200-day and see if we really want to be below it now that we've broken and reversed this Ukrainian rally and come back down to the levels that we were at, at the end of last year. So unfortunately, I don't have much else to talk about on the wheat. We can look at where we are in terms of the next in the series short, though, which does give me some cause for concern. We had an extension short here that was drawn from 1030 lows down to the new low there around $9. It was a front run a little bit there up into the 950 area. But now the new low to low extension, that's where we came up and found resistance here today. I want to see us above 860 before I really call wheat, in a true reversal. But at least intraday, we're starting to see that movement happening, which is good. All right. Let's move to crude oil because I think it's important to talk about our energy products here today. Um, Very much range bound. Yesterday I mentioned that we could be going into this triangle. Uh, Excuse me. Three waves down, choppy price action up, three waves down, A, B, C. Do we have a D and then an E leg of a triangle potentially forming? Maybe. Off the high here from 123 down to the 101 low, 112.55, 50% short held. It went right to its 96.29 target. And a retest, by the way, of that much larger 50% fib from 62 up to 54 at 96.50. So you got big levels here holding and fighting with crude. That next in the series, short will be from entry highs to target lows. Sure enough, 104.57 trades as the high, basically 104.48 here today. What's 10 cents between friends on a market that's moving at $10 at a time? Next in the series short could open up for a move down towards 90.60. It traded here today. It got a reaction. We closed, we're looking like we might close back inside of yesterday's range. 90.60 could be the next downside target for crude. It would be breaking below a bit of a trend line support in that triangle. And by the way, if we get that move, we would be no longer considering this a triangle, but instead an A, B, maybe C leg down that could take us towards 86. The 100% extension, this leg down from 131 down to 96.50, extended from the 123 high, comes in around 86. And that, of course, could just lead towards, a further pullback. There's trend line support right around that area that looks good, but the much larger 50% long from our pandemic lows in WTI crude through the highs comes in around 70. So if you're wondering where, I don't know if it was Bank of America or Goldman, somebody was talking about a pullback, to $65 a barrel. That's where they're pulling that number from. It's where this last rally began from, and it's also the 50% retracement for the entire contract. The continuous contract from pandemic lows to highs. And of course, we're not considering that pandemic low to have gone negative because the only crude contract that went negative was the front month delivery contract that was past first notice. So that's why a continuation chart doesn't show that negative price action, even though the price of delivering crude at the time was in fact negative. All right, so if we do get above 107.50, break that 61.8 line, yeah, we can drop a full 50% short off this high. But the truth is that at that point, I would be thinking that this is more of an A, B, C. We got D up and then maybe another E leg down. Above 107.50, I expect to move back towards 115 to 122 in a D leg higher before maybe one more pullback in E, and then we have a big triangle. We got into this triangle because we broke 50% lines on both from both directions in this range. The 50% short off the highs broke when we went up to 123, and the 50% long off this low broke when we went down to 102. Once I have two of those breaks, I start immediately drawing up trend lines to constitute some kind of ranges forming, and the market seems to stay in that range or consolidate somewhat. We can see the same type of price action happening on the August live cattle. 50% line here, right around 135 broke when we went to 137 highs. That's that from high to low here. And then likewise, we have a 50% level off the lows that broke. And sure enough, the market, for the last month or so has been bouncing around between these levels, forming another kind of triangle-like structure. And if we break below 132, I do think we will be, kind of reversing next supports down to 127 to 123. If we break above 137, potential for this full 50 back from 118 to 141, which traded around 129 at the 130 level, to take us up to 146. But unfortunately, we are, reports and USDA is telling us that we are expecting, the largest cutback in beef production into this next quarter since 2008, and the same for hogs. The only difference is it seems to be the biggest one ever. Feeder cattle, not much different there. We actually went out the day, however, kind of trading a series of shorts to the downside. So maybe feeder cattle, I definitely think it has another push down towards 171 to 170. That's just been the range we've been in. But you can see here, I've got a full 50% short drawn from 176 high to the 172 low. Okay, a little front run there, but got reaction from the 174 area. From that high to the lows today, as we did make lower lows here, we came up and we tested into the 61.8, but we generally held it, and we've started to roll back over all alongside holding this downward sloping trend line. I think feeder cattle have another push down to 170, but likewise, sometimes when you get, instead of getting 61.8 line breaks on either side, sometimes we have 50% lines on either side holding. In this case, the feeder cattle have this full 50% short from a 187 high to the 162 low in the August contract. 174.95 is holding as resistance at 50% line, and likewise off the lows from 162 to 176 after. 169.83 is holding a support around that 170 level. So while those two levels hold, it's kind of anyone's ball game. So we shall see what happens. And last but not least today, well, two quick things to talk about here. The bonds. Bonds are holding a series of longs off their lows now. This is not indicative of raising rates, but from 131 up to the 137.29 high, pulled the 50 back to 134, went to their targets and through targets. Next in the series from entry low to target high here, we have come back down and traded into that level here at 138. Upward sloping trend line against the lows comes in around 136. Certainly looking like we're starting to channel in the bonds here. If we draw up a nice little channel, highs to highs, bring it down to lows, and bam, there's your channel in the bonds that could take us up towards a 144 target. And if we take a step back to the daily chart here and the continuous chart for the bonds, we're still very much in a downward sloping channel. That the upward bounds of that channel are up to 153. And the next in the series big short, swing from 166 high to the low here, I'll highlight it here so it's a little bit more clear. That blue one now highlighted, 148 could be resistance. So that would take us back up into, old levels. Kind of crazy to think that we would go there. But if we are going into a recession, that's what we would expect. Now, the only caveat here that's working against the bonds to the downside, this lows to lows extension short, which is now highlighted. You saw it kind of trade once, twice, third time here, is holding resistance at this 140 to 142 area, as is that downward sloping trend line against the highs, that yellow dotted line. So some cross currents here, which might send the bonds into more of a range here between 142 handle and the 132 handle, a 10-point range while the Fed decides the fate of the world here going into Jackson Hole. Not out of the question, but nevertheless, interesting. And last but not least, here are equity indices. Next in the series short here for the S&P from 42.02 down to the 36.42 lows. Got a reaction on that gap fill and 39.22, 50% short. Got a reaction, what is that, back on 628. Started to sell off. Now inside of this level, we might actually have a bit of a triangle or wedge that could start to form here. In some degree. And the reason I say that is even though we're in a bigger 50% short on this 4-hour or larger time frame, whatever you want to call it, we did break the 61.8 line of a long off the lows and have now broken a 61.8 line of a short off that high. So we could have a range here, basically down in this area while the market is figuring out what it wants to do. We've talked about the full 50% long from 21.80 up to 48.80. That's from our pandemic lows up to new highs. And that comes in around 34.94, which happens to be the downside target around 3,500 for that next in series 50% short off the high. So a little bit of a fight in the trend until we get back above 4,000, though. I don't think the bears are off the plate yet for the S&P, and I do think we could have one more leg lower to complete 1, 2, 3, 4, 5, 6, 7 swings, a corrective 7-leg structure down into 3,500 for the S&P. All right, well, that pretty much concludes today's strategy of the week here for us. Thank you for joining me. Remember, if you're ever interested in turning these ideas into more actionable trading strategies for you, give me a call at 312-277-0110. Find me on Twitter, find me on Facebook, or shoot me an email at dhussey@zaner.com. It costs nothing to have an account with us and to start working with me to get some of these strategies or ideas rolling for you. And always happy to have a discussion about the markets for anyone involved and interested. Have a great day, everybody. Have a great week. Be sure to sign up for the Strategy of the Week webinar in the information section and the comment sections below, because this weekly webinar, where I go into a lot more detail, will fortunately become a closed webinar only for those who have signed up. But don't worry if you don't have time to attend it live or to ask and shoot me your emailed questions. You can always watch the video recording that goes out shortly thereafter. Have a great day, everybody. We'll be back with you in our Strategy of the Day and Strategy of the Week recaps and as price action develops. Take care, everyone.